Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today is Lawrence Lepard, better known as Larry. He runs a gold fund that was up 97% in 2019. How are you today, Larry?
I'm great, Tom. Thanks for having me on your show.
Absolutely. So I wanted to start with asking you, how will we know when the people are going to start to recognize that the currency no longer has any value? Do you think we've gotten to that point yet?
Well, obviously, we're not there in terms of the whole world knowing it. I think some of us know it. Probably the people listening to this broadcast know it. And of course, in investing, that's how you make money. You identify something that you know and understand to be true that other people don't, and then the market comes in your direction. I don't know. People are waking up. I mean, I will say this, that obviously the COVID crisis and the related deflationary / depressionary conditions that we're going into have caused a lot of people to question their assumptions and to wonder what the heck is going on. And my phone has been ringing off the hook from people I haven't spoken to in 5, 10, 20 years who know I'm kind of a gold guy and are kind of like, what is this? And so, I think we're beginning to see, the awareness in the broader segment of the population. But, if I had to handicap it, I'd say we're still at the, 1 to 5% of the population in the United States that's aware. It could be lower than that. I don't know. I mean, I've always been considered pretty fringe to believe this stuff in the circles that I run in. And, they're kind of like, well, why don't you just own Apple and Google? And honestly, they were pretty right for a while, and I was pretty wrong. So you can't argue with that. However, as we all know, those listening to this podcast know, when you have a credit system that creates too much credit and, the credit grows at a rate in excess of GDP, you've eventually created a situation that is what Herbert Stein described in Stein's Law, which is, if this cannot go on forever, it will end. Or if something cannot go on forever, it will end. And I think, in my opinion, we just saw the beginning of that end. Because in the space of 6 weeks, and I'm just writing my first quarter report, in the space of 6 weeks, we were seeing just stunning moves in both the markets, the regular markets, and then in a related sense in the actions of the government to try to calm and tame and hold those markets together. And that's caused awareness. I mean, there are very few people that I'm aware of who haven't looked at what's going on and said, wow, this is big. I need to figure this out. Now, have they all come to our camp? No. And that's a process that we will go through, in the years ahead. And eventually they'll all be in our camp, and everyone will think that, paper money is bad and worthless. And we'll have to set up a new paper money or a new form of money based on, gold, silver, and Bitcoin. And that's coming. But, it's very hard to know the slope of the curve and the timing because, and even if I thought I knew it, you shouldn't listen to me because I've been very wrong for 5 or 6 years. I thought it was coming in 2008. And it kind of was, but then they were able to contain it, do a lot of evil things like Operation Twist, put the inflation back in the can, keep rates at zero, and start another credit cycle. And gold does poorly in credit cycles, and stocks and other things do well. So, it's hard to say, the slope of the curve, but there's no doubt in my mind that it's coming. And I think what we just saw is the next act is starting, and I call that next act the complete failure of fiat and its replacement with sound money.
Do you think there are any strategies left that the Fed can take to have any more effectiveness in averting a further decline?
It's a great question. Yeah, I know. Can they reverse this, or could we be wrong? And I was asked this by a really very high-level, high-powered institutional money manager. I mean, somebody who literally is in a position to control billions. And he asked me, what could make your thesis wrong? Tell me, what could, he said, I agree with you, but what could make you wrong? And I honestly only see one thing that could make the thesis wrong. I mean, there's probably more than I don't see, but the one that I see is if every government in the world decided to make gold ownership illegal and confiscate all the gold mines. And there's a motivation for them to do that, and that is that gold and gold mining. It's an existential threat to their fiat money system. And my belief is that once gold breaks through 1900, which will happen soon, and then through 2000 and 3000 and 4000, Gresham's law will kick in, and everyone in the bond market will say, hey, Fed, sold to you. And, the curve will get parabolic, and it'll just be a matter of time before the dollar's worthless. So if they're smart, they understand that. And then if they're evil, which they are, they go to the next step, which is, all right, we got to prevent that from happening. Summers and Borofsky, with Gibson's paradox paper years ago, set Rubin on the path to suppress gold. And that's how we got to where we are today. So here's the question, and he asked me to handicap the odds that happens. And I said, maybe it's 20%. One, getting a lot of governments around the world to agree is going to be hard. And I'm not sure Russia would go in that direction since they have a lot of gold and they're fiscally pretty sound. I'm not sure China would go there either. They've encouraged their citizens to own gold, and they own a lot of gold. I think the narrative of what's going on here is that, the elites and people in large organizations and places of power are being shown to be frauds, and they're losing their grip on that power, and they don't like it. But, there's 7 billion of us, and they're, a much smaller number of them. And, I kind of compare them to the French aristocracy. I mean, there were, 300,000 French aristocrats in 1788, and 3 years later, there were 15,000, and the guillotine, provided the difference. I don't think we're going there. Obviously, that's wrong, and that's not what I hope for. But my point is that there are a lot of people who, if told to hand in their gold, wouldn't. And there are a lot of people in the United States who are heavily armed. And, I think the elites, are probably aware that there's only so far they can go. And so, to me, the more intelligent way for them to address this, once they realize it's getting out of control, is to halt the markets, stop, and do a one-time devaluation of the dollar, where they $10 old dollars equals one new dollar, and the new dollar is fully backed by gold, and they go forward on a new reduced basis. In a sense, it's a debt jubilee or a restructuring. Will they be intelligent enough to do that before we get to hyperinflation? I don't know. I kind of doubt it. I actually think we'll get to the stage where the dollar is completely worthless, and there will be a complete political upheaval. And then, some people will run for office that are actually quite honest. And it'll be obvious that they're honest because of the things they're saying about sound money and other stuff. And they'll be voted in overwhelmingly, and then they will investigate the people who did this to us. And, Ben Bernanke will be in the history books right there with John Law. And that's what I'm living for. I'm 62, and I hope I live to see it. I think I will. Because, this evil system is going to collapse on itself. And as you and I discussed in the prelude to this call, all the rules are going to change. And I like the cards we hold, but could they mess with it? Sure, they could. And, they may try and jam us into a crypto of some kind, but, or they may, Rickard says we're going to go to some super SDR as the reserve currency. And I say, no, guys, you just don't get it. This is going to be bad enough that nobody is ever going to trust government, big centralized government again, ever. Or to the degree they do, it's only after it's going to be severely and significantly reformed. And, it's going to be, unfortunately, a messy process. The positive of it all, and, I've got kids, is that I think we will get through it. And I think once we reset it, it's going to be so much better. The world is going to be such a better place, with sound money and with all the corruption, or a lot of the corruption weeded out of it. The military industrial complex, be a shadow of its former self. The notion of, large warfare would disappear, etc. So that's a windy answer to your question, but it is the one thing I get concerned about. I mean, if they try and grab all the gold and grab all the mines, what are we going to reset against? I mean, in a sense, that's an argument for Bitcoin, right? They could try and shut that down too. But once again, look at the numbers, look at the math. There's 7 billion of us, and you can only piss on our legs so long and say it's raining. We'll figure it out. Is my belief.
Absolutely. Hopefully that re-education is coming. As we look at let's say, how to hide in that storm, one of your main themes is to place an asymmetrical bet. We have $400 trillion of paper investments, and maybe go through and explain to us a little bit about where that money can go and how small the markets are for.
Yeah, it's a great question. I mean, there's 190,000 tons of gold in the world, from the beginning of time, and some of it's in mosques and churches, and some of it's around women's necks in India, and some of it's in central bank vaults, and they're not going to be selling it. If you actually look at the value of the tradable gold, of bullions and coins today, last time I did the math, it was about 2.7 trillion. And there's about $1 trillion plus or minus, and these are rough numbers, of gold mining equities out there. So let's call it 3.7 trillion on 400 trillion of all stocks, bonds, and cash in the world. So it's less than 1%. It's just a sliver less than 1% of assets out there. And I think what will happen is people will realize these people who are the monetary stewards are just going to print money forever. We know what that means. That's Zimbabwe, Venezuela, and Weimar. And, gosh, I own these bonds. You know what? I bet they're not going to hold their real value. Maybe I need to sell some of those bonds and buy some of that gold. So you're going to have some fraction of the 400 trillion chasing the 2.7 or the 1. So, what happens if 10% of the people holding the financial assets say we need to hold this other stuff? That's 40 trillion chasing something today that's on a market that has a market value of, let's call it 4. That's 10x, on today's gold price. I mean, that's $16,000 gold. In order for, because you can't, it's not like we can increase the supply of gold that much. I mean, it grows at 2,900 tons a year, plus or minus. And so that's, 1 point some odd percent. So, that's what I think people are failing to understand, is that that's a really asymmetric bet. I mean, gold's not going to zero. It took time and money to get it out of the ground, and I doubt that anybody is ever going to say gold is worthless completely. Gold obviously can go up and down. I mean, it went from 1,900 to 1,000, so that was if you bought it at 1,900, that was a 50% loss on your money. And who knows, it could happen again. But the point is that it could also go the other direction, and it could go, it could double, triple, quadruple, quintuple, and that's an asymmetric bet, right? And then there's the probability. What's the probability of the one versus the probability of the other? Well, maybe a few years ago, what I'm describing didn't look very likely, because the economy is doing well, and hey, gold. Who needs gold, right? I'll buy Apple. But that's changed, right? I mean, you've now just had, to me, what just happened looks kind of like the GFC, the global financial crisis in '08, and all the debt is now in the process of being destroyed. And, the government, in order to try and keep the system working, has to support that debt. And they only have one way to support it, and that's to print fiat and get it into the system any way they can. And, as the debt's destroyed and people sell the debt, the government says, fine, I'll buy the debt to hold its value up, even though it's a bursting bubble. But in the process of buying the debt, they're printing money. And that printing of money, there's only so many goods and services in the world, and there's so much money and financial assets in the world. And the money and financial assets represent a claim on the goods and services. And of course, the money and financial assets got into a huge bubble. And so, the money is bad, and therefore, but the goods and services are real. And so, as that bubble collapses, it becomes apparent the money is bad, and people will move to a money that's good, which is gold. Has been good for 5,000 years, gold and silver. So it's an enormous asymmetric bet, and in my opinion, it could end up being one of the largest wealth transfers in the history of mankind. I mean, I think it's going to absolutely stun people. What's going to happen, in the next 5 to 10 years? I think it's going to be truly stunning. And some of us have been saying this and saw it coming, and we've been called crackpots, but when it happens, I suspect people will view it somewhat differently.
Is 16,000 possible, and what are the next important numbers on the way up to that?
Right. Well, just as a market analyst, I mean, how things go. I mean, the first big important number is 1,900, because that was the high in 2011. I mean, plus or minus, I don't have the exact figure, but so when we take out 1,900, let's say, hey, gold is at an all-time high, historically forever. And by the way, as you're probably aware, and I'm sure everyone listening is aware, it's already at an all-time high, almost every currency. I'm not sure where it is versus the Chinese yuan, but I know in all other major currencies, it's already at an all-time high. So it's just the dollar, which, has been the reserve currency, that it's not at. So that'll be a big one, right? We're, all-time high in price of gold. That'll wake people up. It'll be at the top, that'll be on newspapers. Then the round numbers start to become important. 2,000. Oh, wow. That's, $2,000 gold. I mean, it was, at one point it was 1,000. Now it's 2, and then, okay, 3,000. Oh, geez. I mean, it's not coming back down. What's going on here? 4,000, 5,000. And I mean, 16 could be just jacks for openers. I mean, it depends on a lot of things. It depends on how much money gets printed. And I've seen calculations all over the place. It depends on, eventually we're going to go to a gold standard, right? And it depends on how much, you can have a gold standard with 100% coverage of the outstanding monetary base, or you can actually make it work with like 40% coverage, because not everybody's going to demand the gold instantly. So, I've seen math that shows gold prices should be 10,000, 20,000, 40,000. You can get to 100,000, almost on today's money outstanding. And by the way, the money outstanding, is growing almost at a parabolic rate. I think a number that's very important for people to focus on, probably haven't, is so the Fed balance sheet before this whole thing started was $3.7 trillion. It's now, in 2 weeks, it's gone up to 5.8. If you take the growth rate in the last 2 weeks of the Fed balance sheet and you annualize it, the Fed balance sheet is growing, and it may not continue at this rate, but it might. It's growing at a $30 trillion annualized rate. So the Fed balance sheet represents the money in the system, or money and credit in the system that's given to banks and then loaned out through fractional reserve banking. And so, basically, if we were to continue at this rate in the next year, we would be increasing the money / credit in the system by a factor of 10x. Now, how do you increase the money? You only got so many goods and services. We haven't increased the amount of food or oil or cars or anything else in the world by 10x, but we've increased the amount of money by 10x, and the money eventually will chase the goods. There's a lag. But, so how do you not get price inflation in that environment? And then, also in that environment, how does the bondholder who says, I'm thinking, I'm going to get paid back at some point in the future, not start to worry about, they'll give me the money back. My $1,000 bond will be worth $1,000, but what's that going to buy? In real terms, if there's inflation and everything else, that's not going to buy nearly as much. I need to sell that bond. And so they're going to say, all right, I'm going to sell it. And, in turn, what that would normally do is it would drive interest rates up, because, you sell a bond, there's less demand for bonds, and therefore interest rates go up. But in this case, the Fed has already signaled that they're going to do YCC, which is yield curve control. They know that the world can't live, a highly leveraged world can't live with higher interest rates. And so what they're going to say is, all right, we're about to, and this is financial repression. It's what they did after World War II, because we ran huge deficits in World War II. And this is what the modern monetary theory crowd says. You go back and you look and say, well, we got through World War II without hyperinflation. True, but the dollar was backed by gold then. So it was a slightly different world. And, they're gonna say we can't let interest rates go up, so we got to buy those bonds when they come up for sale. And they've already talked about it. Lyle Brainerd signaled it in May, and then Powell reiterated it this fall that they're going to do yield curve control. And so the bondholders are going to say we're selling this bond, interest rates go up. Fed's going to say we can't have interest rates go up. We're going to buy that bond. How are they going to buy that bond? They're going to print money to buy that bond. That's going to make their balance sheet get bigger. And so what I see happening is this is a doom loop, right? The more money they print, the more inflation goes up. The more inflation goes up, the more bondholders say sold to you, Fed, which means they got to print more money. So, can you see how the problem, the solution to the problem makes their perceived solution of the problem, which is print money, makes the problem worse, which is, there's a lot of money chasing fewer goods. There's more inflation. And that's how it happens. That's how it happened in Weimar. Now, somebody said, well, isn't there a way they can stop printing money and solve the whole problem? Yeah. And this, by the way, happened at a small scale in the 70s, right? So, Paul Volcker came in and put interest rates. We had runaway inflation in the 70s, or high inflation, not hyperinflation, but very high inflation, in the teens. And it was getting away from everybody. The dollar was sliding. And, gold had gone from a $35 fixed price, which was suppressed, to an $800 price in the late 70s. And there were people thinking the dollar was going to fail. And Paul Volcker came in and said, no, we're going to stop that. And he put interest rates at 20%. And because the world wasn't so leveraged at the time, the world was able to handle that. I mean, it almost put my father out of business. He had a business that had a lot of debt and carried a lot of inventory. And, 20% interest rates was brutal, but he made it, and most businesses made it. And then interest rates came down and things got more normal, and inflation subsided. But the way to handle inflation is to push real rates up extremely high. But, can you imagine, even if we took interest rates to 5 or 10% today, most of the country would go bankrupt. I mean, hell, the Fed wasn't even able to normalize interest rates back up to 3.5%. I mean, I think they only got as high as 2.5% in this last cycle. So the point I'm trying to make is that the Fed is really trapped. And if you read the history of Weimar, which I've done, I've read every book I can on Weimar, it was the exact same thing. I mean, Rudy von Hohenstein was the central banker there. He was forced to, it was kind of like, I've got to, I've either got to keep printing money now and hope that we find a solution, or I've got to stop printing and the whole thing's going to collapse into a pile of rubble. And, the thing ultimately did collapse into a pile of rubble with the money being worthless. But by printing, he was able to extend it out a few years. And, I feel like we're watching history repeat right here. I mean, it's ironic that happened from 1920 to 23. And the real severe inflation there was a 3-year phenomenon. And isn't it odd that here we are in 2020, exactly 100 years later, and it feels like we just kind of crossed the Rubicon with all this, all the government programs that just got put in place. And that's the other thing I should mention that's really stunning to me. I mean, they went from a deficit of $1.5 trillion kind of as a run rate to they just and I'm not saying they shouldn't have done this. It's compassionate to help people who are hurting from this COVID thing, but they went out and they did $2 trillion of spending, just bang, no problem. Then they borrowed another 4, or they're going to blend another 4 into it, some of which will be forgiven. So that's 6. And then Trump is calling for a $2 trillion infrastructure bill. So the U.S. federal deficit is about to go from 1.5 to, I'm spitballing it as kind of 6 or 7. So we've got tax revenue, tax income of, kind of, 2.5, 3, something like that. Well, it's over 3, but it'll go down with this downturn because people aren't working. And so I was spitballing as kind of like 2.5, because of the fall in economic activity and in tax revenue, and then, 7. So we're going to run a 5, 6, $7 trillion deficit, and we're going to print the money to do it. And the base money supply pre all of this was $3 trillion. I mean, really, we're going to, I mean, it's just stunning, Tom. I mean, the whole thing is just stunning to me. And so, it's very much a case of the game is afoot. And, and by the way, a lot of people figured it out, right? Take a look. I find it fascinating that, in the last 3 weeks, and I talk to and deal with a lot of coin shops. I mean, I've got an email from one of them that said the demand for their product went up 10x in under a week. And, and you can't find in traditional coin dealers who used to sell coins at premiums that range between 3 and 12%, kind of averaged in the 5, 6, 7% range. You can't find anybody who has any with this at that kind of a premium. I mean, the premiums are much, much higher. I've seen as high as
we're up over 20% right now. Last time I looked.
Right. For gold. And then the silver is more if you can get it. And of course, eBay is, that's crazy pricing, but I've seen eBay pricing the premiums 100%. So yeah, people figured it out, right? The money, what's going on here, the big picture view of this just is the money's going bad, folks. And, and so given that the money's going bad, yeah, you use it for transactions. You have to, you can't pay in gold, but, it's inconvenient to pay for things in gold, although there's services that are addressing that. But the money's going bad. So your savings, you've got to get them into gold or silver or gold and silver mining companies, although they have a lot of risk. So it's very obvious to me. And I think what will happen here is it will become obvious to the whole population over some period of time. And those of us who've been in the investment world for a long period of time know that if you're able to find something that, a lot of people are going to gravitate toward, you can make a lot of money. I mean, before I got into this area in 2008, I was a venture capitalist, and somebody gave me a card with an internet address in 93 and explained what it did. And I thought, good Lord, this is really powerful if they get it working right. And so I started making a bunch of investments in that area, and it worked incredibly right. I mean, it was clunky in the beginning, but eventually they got a browser and they got graphics, and the broadband came along. You didn't have to do dial-up and so on and so forth. And, we were in front of an enormous trend and therefore made a lot more money than we deserved to make. But, I'll take it. Thank you very much. And I kind of feel like that's what's going on here. I mean, that was an asymmetric bet, and where there was a good idea that a bunch of people were going to gravitate toward. And I think this is a similar kind of thing. It's an asymmetric bet that, sound money is important. The world is structured in a way that it's going to become really important. Some of us understand that and know it. More people are learning it every day. And, to me, the way you can tell where we are on this roadmap is just look at the gold price. Just chart the gold price and look at it. And there's another interesting thing to talk about. There's a lot of interesting stuff happening there, right? I mean, the spread between the futures and spot, is huge. The premiums last night were $70. You never used to see that in the past. And what that tells you is somebody's willing to pay. The spot price is a bullshit price. It's the Comex fraudulent price, based on what, people, they say they're trading gold at, but what they're really doing is they're trading paper at that level. People who know what gold is, they're buying the futures price, and the futures price is already over $1,700.
Even the spot versus futures versus physical is a major disparity.
Exactly. And what that tells you, there's stress in the system. Another example of that is, you saw, and I mean, this is a classic, they're denying that there's any problem, right? But the Comex was having trouble sourcing 100-ounce bars. And so the LBMA in London said, oh, yeah, no, don't worry. We're creating a new contract that's equal to four Comex bars, and we'll ship you some of our 400-ounce bars. But there's nothing to see here, folks. Everything's good. We got plenty of gold. There's a huge stockpile in our vault, even though a lot of it's already spoken for. And, it's kind of like, they denied it 3 times. I mean, how do you know when a government's lying? When they deny it 3 times. And, there are people, there are bloggers on Twitter and others who've pointed this out. One of the best, by the way, I highly recommend everyone follow Alistair McLeod from Gold Money. The guy's a genius, and he really gets it. And, he's pointing out that he's been blogging and explaining this problem in supply, and he's been getting all these emails from the LBMA and Comex kind of trying to calm him down. Like, no, we got plenty. It's all good. And it's like they're protesting too much, right? I mean, they got a serious problem. And that brings up a whole different issue, which is the issue of paper gold. I mean, Jeff Christian of LBMA, Aaron and Goldman Sachs back in the day testified in front of the CFTC that there are 100 paper claims for every real ounce of gold in the world. If that's the case, what's going on here is they're running the largest game of musical chairs ever played, right? And so people who own GLD or they own a paper claim on gold are at great risk of coming and saying, please give me that gold, and it won't be there. And the person who issued them the claim, the counterparty is going to fail. The counterparty is going to be Lehman Brothers. They're not going to have the gold to deliver. And, at some point, what could happen here, what I anticipate happening here is actually, and this is a mistake that all financial models make, they assume continuous pricing and continuous price models. It's entirely possible here that what happens is we wake up one day and the price of gold is $5,000 an ounce, and there's none for sale at that price. I mean, that's how it's going to end.
And it's just going to keep spiking from there, correct?
Yeah, right. And there's literally going to be no dollar price at which you can buy gold. And the reason that's the point at which the dollar has failed, because no one wants one, and everyone who has one will be doing everything they can to spend it as quickly as they can to get something real. And they'll be paying, $10 an egg or $1,000 to fill up their car or whatever it is, because at least that's gasoline, not paper. And that's how it happened. And that's how it happened in Weimar. The difference was just that they actually had wheelbarrows, and they were, they had these notes, and they were wheeling the money around. And the thing that's different about Weimar than today is the hive is so connected, and you can do all this with a mouse click. We're not going to need, we don't need wheelbarrows. All we need is a mouse. You move your money, take it out of here, put it over there, buy me some gold.
So as we were speaking of asymmetrical bets, Lawrence, do you think silver, as we saw the recent gold to silver ratio was at an all-time high, do you think that silver has even more explosive upside?
I do. I mean, most of your listeners probably already know this, but I mean, silver is gold on steroids. It's much more volatile. There's not as big a stockpile. It gets absorbed and used in industrial and solar applications, and medical applications. It's the junior brother to gold. It's easier for the common man to own because it's gold's more expensive, and there aren't as many ways to buy. Some people don't have the money to buy big amounts of gold. Yeah, and it's also a little more tied to inflation because of the industrial use piece of it. But it is fundamentally a precious metal, and it's been money for a long time, and it's rare and it's hard to mine. And to me, it's going to do extremely well, but with much bigger amplitude swings. I was reviewing it with somebody on the phone yesterday. I mean, in the 2008 to 2011 run up, I think gold at the bottom of 2008 was about 7,000. I think it went to 1,900. So it did kind of a 2.5 bagger. And that in that period of time, I think silver went from kind of 910 to 50. So it was a 5 bagger or more. I may have those numbers off a little bit, but the point is that it's high beta gold. And I own a lot of silver too, and I own a lot of silver miners, and I believe very much in silver. It's as a metal, storing it personally. I mean, to get a lot of value into silver, and I've done that. I bought a lot of silver, and I bottomed out the shocks in my pickup truck because it was so damn heavy for the amount of money it was there, and I could have put the same amount of value in a couple of briefcases, in gold. And that's the problem. I mean, the silver's heavy relative to its value, and it's harder to store and so forth. But it actually makes a great metal for everyday transactions. I mean, it's hard to make change for 1,000 or for a 1 ounce gold coin. It's pretty easy to make change in junk silver quarters or even a silver ounce, which today is, well, the spot price is $14, but the real market price is $22. I mean, $22 is a really nice amount. I mean, it'll be much higher in the future, but that's a tank of gas, or that's a bunch of steak, or that's dinner for a couple people, whatever it might be. And I don't know if we'll ever be exchanging coins. There's probably, in this transition, there'll probably be a very brief period where the money will be kind of completely broken, and I'm not sure if we'll kind of go back to a barter, but the government will have to very quickly come up with an alternative currency solution, and they're going to have to back it with something, or else people won't accept it.
So to take a riskier view of, let's say, investing as we go through this transition, I know you like small producers, and if you could give us kind of your thesis on.
Yeah, well, let me take you through kind of all from top to bottom, right? So I think everybody should start off. They should own some gold. You shouldn't even buy some miners until you own some gold, because the system could totally blow up. The stock exchanges could blow up. I'm not saying and believing any of that will happen. I'm just saying the gold is the core of your savings. You should own it. You should own it in your own possession. Okay. Then you should own some silver. That's next. The reason you should own that is that's good for transactions. The same story in your possession. You could use it for transactions in a world with no money, no working, functioning money, which would only be a brief period of time. Then, okay, so those are, to me, that's, in the bonds, cash, or in the bonds, stocks portfolio that every investment advisor says, well, you should be, your age is, put that amount in bonds, but 40% in stocks. I'm 62. Well, to me, I should have 60% of my money in gold and silver, and then I should have 40% in stocks, kind of, because stocks are risky, and stocks are, gold is the goose that lays no eggs, right? It just sits there. That's Buffett's line. It doesn't grow except to the extent it grows vis-a-vis fiat. Stocks, on the other hand, gold stocks, that's a goose that actually lays eggs. They're pulling gold out of the ground and creating positive cash flow if they're doing it right. Within the gold stock universe, let's go from top to bottom. The safest, with the least downside in this last downturn, the safest place, the place to put my mother's money, is in the streamers. It's a better business model. They're very diversified. They let other people take a lot more of the operating risk. They're taking their money kind of off the top in the form of a royalty or an NSR or a stream bought at a fixed price or slightly increasing price over time. And so, the streamers, Franco-Nevada, Wheaton, Sandstorm's a favorite of mine, and others. That's job one, or safety job one. Then you just start to go down the market. You've got the majors, the well-run majors like Barrick and others. I like Kinross and Eldorado. Agnico's an extremely well-run company. It's not cheap. And there are a number of other majors in various stages of being good or bad. The advantage with them is that they generally have a lot of properties, and their management's fairly professional, and there's just less volatility and risk, although there's volatility and risk there. The problem with the majors, from my point of view, and why I don't hold a lot of them, is that they're very hard to grow. When you're producing 5 million ounces, it's hard to grow your production by 20%, or 30%. And if you want, when you're buying stocks, it's getting hard to replace the ounces you mine. And so if you're buying stock, in a gold mining company, you want increasing production and increasing cash flows for the obvious reasons. So where I participate much more heavily is what I would call the mid-cycle or mid-size emerging producers who aren't producing 5 million ounces. They're producing between, in some cases 50 or 100, but more likely I've got a lot of companies that are producing between 200 and 600,000 ounces per year. And they tend to, be growing that over time steadily. They tend to have a good cost profile, and they tend to, be profitable. And in fact, in all cases, they're profitable. I won't invest. And they, in today's world, actually, they're ironically selling at pretty low multiples to cash flow. I mean, I've got several that sell at 2x cash flow. I've got a lot that sell at 3, 4, 5x cash flow, which is really cheap. And when you're in one of the majors, as an example, last time I did the numbers for Barrick, they've probably gotten better with higher prices, but I think Barrick was 12x cash flow. So, if I can buy a gold miner at 3x cash flow and the majors are selling at 12x, I've got a shot at multiple expansion, right? So the producers, that's 70% of what I'm doing. The next two categories are the developers, which are people who found gold, have it in the ground, but have not built the mine to bring it out yet. And there's a lot of risk in that process. I mean, a million things can go wrong. It's like Murphy's Law on steroids. So, but occasionally you can buy them cheap enough and the team is good enough and the deposit's good enough that you can think, well, if they're able to pull this off, this is really going to be worth, 10x what I'm paying for it. And therefore it justifies taking the risk that they won't be able to pull it off. So it's asymmetry with more risk. And the third category, the drill stories.
Are there some names you'd like to share with us in the developer category?
Yeah, I've shared a lot in the past, and I'm as a result of advice from a lot of people, I'm cutting back a little bit on my sharing. I will say that for what it's worth, I mean, and so obviously I'm in favor of these two companies. I am on the board of Amarillo Gold, and I am on the board of Rise Gold. They both have substantial risks, so I'm not humping those stocks. I've made investments in them. I believe in the combination of risks and rewards there, that they're attractive. Actually, they're a little more attractive, particularly Amarillo is a little more attractive now than when I got in because this downturn has hit it. But, this is a risky space to be involved in, and it's going to take time and a higher gold price for these to both work out. But, you could get multiples of your money in these if they work, particularly in Rise. And you're not going to get, look, in a higher gold price environment, Barrick will double or triple. In a higher gold price environment, if these opportunities work, I can't see how they're not at least 10x. So, invest accordingly. They could also be minus 1x. And that's happened before, and I've been wrong before. So, so use caution. I mean, I think, somebody who's in this area who wants to speculate and wants to put 1% of their capital in something like this, knowing that if it works, it could really be a winner, and that might make some sense. It depends on who you are. But the final story, the drill stories, and these are people, geologists who have knowledge of rocks and structures and, can basically make a strong argument that if we put some drill holes in an area, we'll find a deposit. And if they do, it can be a 10 to 100 bagger. And if they don't, you lose all your money. And that's about 10% of my portfolio. And, I've got some names and stories I like there, but again, I'm going to hold back. Part of the problem with recommending names is that you recommend a name and a lot of my names work great, but then occasionally you really blow it. Like I went on Twitter and I recommended a name and a goddamn company just, cocked it up so badly. I thought there was no way they could, but they did. And, I feel pretty bad that I recommended that name and I lost money on it too. And the one I'm talking about is TMAC, so, it's these all have risk and we all know that. And people need to be aware of the risk they're taking when they're investing in these stocks. It's, you can make money in them for sure, but it's not easy. And, anybody who tells you it isn't really thinking through or doesn't really fully understand the space.
Larry, I really appreciate your time as I know you're busy writing your March quarterly letter. Can you tell everybody where to find you?
Yeah, sure. So there are two ways to find me. I'm on Twitter, so it's at Lawrence Lepard, just one word, Lawrence Lepard, Lewrence Lepard. And then my email, if anyone sends me an email, I'll add them to the mailing list and send my most recent reports, and they'll get future reports. These are all free. Lepard, so 2 L's, EPARD, at EMA, the letters Edward M, Mark A, Alpha, the number 2, not spelled out, but the number 2.com. That's my email. So, and I try to help people as much as I can. I do get more emails and more DMs on Twitter than I'm able to respond to, and I apologize for that. I just, job one is for my investors, trying to pick the right names. And when I have time, I respond, but I just don't always have time. So if I don't respond to you, please don't be insulted or take it personally. I'd help everybody if I could and if I had the time.
Excellent. Well, your Twitter feed is very valuable, and you're very active there. It's one of my favorites. Thanks for your time today, Larry.
Oh, thanks, Tom. It was an honor to be with you, and I hope we're able to talk again in the future.
Absolutely. We'll be glad to have you back.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?